Hi, I'm David Ware with Ware Financial. Welcome to our Quarter 3 Economic Review. We believe an informed client is our best client. So as you watch this, please keep in mind it's a review of the months of July through September. Resilience illustrates the ability to withstand challenges or recover quickly from difficult conditions, and U.S. equity performance over the past year, including the third quarter, was just that, as markets surged past record highs despite numerous potential sources of volatility, largely fueled by optimistic investor sentiment around the AI boom, robust corporate earnings, and expectations of further interest rate cuts. The U.S. stock market continued its bull run that began in early 2023. The artificial intelligence boom is continuing to drive growth in the technology sector, dominated by the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. In addition to the AI boom, strong corporate earnings and the Fed lowering interest rates for the first time this year also helped the market rally this quarter. The S&P 500 gained 7.79% in the third quarter, closing at 6,688. Year to date, as of September 30th, the S&P 500 is up almost 14%. The Dow Jones Industrial Average closed at a record high, gained 5.22%, and ended the quarter at 46,397. Year to date, as of September 30th, the Dow Jones was up over 9%. In August, the core personal consumption expenditure, PCE, remained steady at 2.9%. The Consumer Price Index is a key statistic used to measure U.S. inflation. It has slowed considerably since it surged to highs in 2022. The annual Consumer Price Index, CPI, which excludes food and energy, was 3.1%, according to the Bureau of Labor Statistics. Consumers remain resilient despite some slight price increases resulting from tariffs. While tariffs have created less of a threat than was previously expected, their lingering effects remain a concern. In response to a moderation of economic activity, the Federal Open Market Committee voted in September to lower interest rates for the first time in 2025, establishing a target range of 4% to 4.25%. Equity markets reacted positively to the news, the major indexes reaching record highs. Looking ahead, there are two more FOMC meetings scheduled for the remainder of 2025. While uncertainty surrounding the economic outlook persists, the Fed has indicated that additional rate cuts are possible this year, though not guaranteed. Bonds, which can be viewed as a safe haven for volatility, were not exempt from volatility in the third quarter. Like many things, the direction of bond yields remains unclear. However, with the Fed anticipating lowering interest rates this year, we could see existing bonds rise in value. Bonds have an inverse relationship with interest rates. When one goes up, the other usually goes down. We consider using bonds when they are appropriate for portfolios, and when we do, several factors come into consideration, including a client's risk tolerance, time horizon, and overall investment objectives. Bonds can be an integral part of a well-diversified portfolio and usually offer stability during times of market decline. However, please remember, while diversification in your portfolio can help you pursue your goals, it does not ensure a profit or guarantee against a loss. Safety comes with a cost, and major banks are still only offering low interest rates to savers. According to Barron's, the average bank money market rate on September 29th was 0.56%, and the average 12-month CD rate was 1.96%. So for anyone who is interested in exploring sources of better interest rates, please contact our office. Based on historical data for the S&P 500 index, the fourth quarter has been the strongest performing quarter for equities. Since 1950, it has delivered the highest average return and the highest probability of posting a gain. Seasonal factors like holiday spending, corporate earnings, releases, year-end capital inflows, and portfolio rebalancing contribute to this strength. This chart reflects returns since 1950, which includes several very difficult fourth quarters, including October 1987, when the market collapsed and experienced its worst single-day decline in history. When studying the returns, 80% of the time, the fourth quarter ended the respective year on a high note. So we want to remind people that we encourage long-term investing. If you examine a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe downturns, historically, long-term investors have been rewarded. Here's some key takeaway. Despite periods of volatility, equities continue to reach record highs in the third quarter. The rally was fueled by the rapid growth of artificial intelligence, a resilient labor market, consistently strong corporate earnings, and the Federal Reserve's move towards easing rates. In September, the Fed reduced the federal funds rate by 25 basis points to a range of 4 to 4.25%, with projections of additional cuts later this year. Inflation remained stagnant during the third quarter. In July and August, the personal consumption expenditure, PCE, held steady at 2.9%. Traditionally viewed as a safe haven, bonds experienced some volatility of their own during the third quarter. Historically, the fourth quarter has been the strongest performing quarter for the S&P 500 since 1950. While we remain optimistic, we continue to monitor potential headwinds, including a slowing economy, the effects of new tax legislation, tariff impacts on consumer spending, the path of inflation and interest rates, and heightened geopolitical uncertainty. Focusing on your long-term goals and staying the course of a well-guided plan can help you stay grounded and confident during these times of uncertainty. We are here for you, so please reach out with any questions or concerns. Your financial well-being is always our priority. 2025 continues to be a year of change for the U.S. As your financial stewards, we closely monitor areas that we believe are important to your financial well-being. We will keep you updated on developments that could impact your personal situation. Once again, thank you for your trust in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from it.